On this week's edition of Dollars and Cents, we're going to share with you some firsthand personal observations about what it means to be in an IRS audit of one's personal tax return. The things that you need to know, the things that you need to make sure that you are doing, and along with some observations as we went through that process earlier this year, and wanted to share with you, our listening audience, some observations and some recommendations based on that personal experience. So you want to make sure you really kind of tune in on the program this week, because there's a lot of sort of misconceptions about what that process looks like. And we're going to try and go through that based on our own personal experience during the course of the first 3.5 months or so of this year. So welcome on in to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, all of whom are certified financial fiduciaries as well, along with various other areas of expertise among the group. They stand ready this week to help you improve your life with a successful and cost-effective financial plan. And don't forget, we're running a free offer to do an in-depth portfolio analysis of your current portfolio. If you're not a client of Nelson Financial Planning, we've got the tools where we can take your current portfolio, run it through a very sophisticated software, show you what you actually own, where the issues are, where the risks may be hiding, and what the costs are. So make sure you take us up on that special offer. Visit Nelson Financial Planning to connect directly to us and schedule that absolutely free conversation. So last week on the program, we talked a bit about the 9 purchases, courtesy of an article that we found from AARP, that could undermine your retirement, particularly if occurring close to the start or right at the beginning of retirement. And so today, as sort of a continuation of that, we thought we would discuss a Wall Street Journal article that was sort of the same circumstances, but more specific in terms of those overall financial mistakes that you need to avoid as you approach or start retirement. So last week, some of the purchases that you want to make sure that you avoid, or at least try and avoid the buyer's remorse on said purchase. This week, it's really more about those overall financial mistakes. So the two sort of go together, if you will. And when you think of it like this, you think of those actions or activities, whether they're purchases like we talked about last week, or whether they are financial mistakes that we're going to talk about this week. If they're occurring close to retirement or at the start of retirement, that's kind of like the fourth quarter of the game, right? We all know that the Orlando Magic, see, I've got the Orlando Magic water drinking glass here that we're prominently displaying for the folks on our YouTube channel. Orlando Magic are in the playoffs for the first time in a few years. And if you've watched any of these games, it seems like they all, particularly in the playoffs, they all come down to the fourth quarter and probably like the last 5 minutes of the fourth quarter. And so if you think of it that way, retirement and the decisions that you make, particularly the timing of those decisions, can certainly affect the outcome dramatically of your retirement and the success of your retirement, particularly as you're making those decisions towards the end. So not unlike the Orlando Magic playing in the fourth quarter of a playoff game, what they do at that point is going to determine the outcome of the game, so too as you approach retirement. So Yet the reality is you're getting close and you don't want to blow it. So here are some of the more common financial mistakes, courtesy of an article from the Wall Street Journal. We're also going to add a couple of our own in at the end just to really paint the picture. So one of the things that I think people forget to do is in those years where they're leading up to retirement, more often than not, those are your maximum earning years, right? That sort of makes sense as you're working along, when you're 25, right? You're probably just starting out, not making a tremendous amount of money. By the time you get to 35, well, yeah, you probably should be making more, 45, even more. And then at 55, you start to kind of crest out in terms of your earnings. And so as you are in those peak earning years, what you need to do is really maximize your retirement contributions. If you're 55 or 60 years of age and you're still, maybe only doing 10% of your salary, well, that's not maximizing it out as much as you could. There's a common misconception of when I ask people, are you contributing to your does your employer have a retirement plan like a 401k? And everybody says, okay, yes. And then I say, okay, well, are you maximizing that out? And they say, oh yeah, I'm doing the 8% or the 6% that gets me all of my employer's match, and that's fine. The reality is, though, that's kind of the starting point. So if you're approaching retirement and still kind of stuck at the starting point in terms of how much you should be contributing, that's exactly what we're talking about. You want to be trying to maximize out those retirement contributions, particularly because you're in your peak earning years, number one. Number two, you're getting closer to retirement. And the usual 8% or 10% of salary isn't going to come close for the vast majority of people to the actual maximum amount that you can contribute to a 401k. For the year 2024, assuming you're over 50, that's a total of $30,500. So that's quite a bit more than just kind of a 5 or 6 or 7% of salary for most people. So those are the kinds of things that you want to adjust. It would be a mistake not to try and maximize out those contributions, particularly if you are approaching retirement. So that's one of the things you want to make sure you're doing is maximizing out, not just to get the match, you should be doing that all along, but really maximizing out to put the most amount of money away that you can as you are approaching retirement and, in theory, in those peak earning years. So one of the things that's going to require you to do is to double check how much those contributions are. If you're on sort of all those automatic contributions, the reality is that this contribution limit for employer plans, which for folks over 50 for 2024 is now $30,500 per year, that number has increased quite a bit over the past few years. So if you maybe set your contribution limit at a percentage, you really want to double check that, because more than likely, you are falling short of that. Another big one, and certainly every time fellow certified financial fiduciary Rob Field at Nelson Financial Planning joins us on the program, we always kind of talk about Social Security. And it is a significant part of your retirement and a significant part of the income that you're going to have in retirement. And so the mistake there is to not really understand what all of the options are and how all of the options work together. And the reality is that you really want to be thinking not just about what your Social Security benefit might look like, but what your spouse's Social Security benefit is going to look like. Because the reality is you may be able to apply under theirs, or you may have the option to say, okay, well, I'm not going to apply under mine and wait for mine to ultimately build up. We're going to take a break. When we get back, I'm going to kind of give you our general view on kind of that Social Security topic, and then we're going to continue on this conversation about some of the financial mistakes that you want to make sure that you're avoiding as you approach retirement. All that coming up next on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about some of the financial mistakes you want to make sure that you are avoiding as you are
Hold on.
Whoop, okay. I'm so excited. I'm ready to go.
That was my fault. Hold on.
Talking about some of the financial mistakes you want to avoid if you are getting close to retirement or maybe have just started in retirement. Before the break, we were talking about a couple of them. First, failing to maximize your retirement contributions. So important, particularly because in those years approaching retirement, those more often than not are your peak earning years. So you want to take and make sure that you are maximizing your contributions. The reality is that means much more than just doing what the employer matches. You can put up to $30,500 into a 401k, 403b, or deferred comp if you're over age 50. That's a lot more than just, say, 5% of your salary for the vast majority of people. Another mistake is not really understanding all of the Social Security options that are available to you. That's why at the office at Nelson Financial Planning, we have a national Social Security advisor to kind of really, who's an expert on kind of all of those options. Generally, what we would say is that if you haven't saved enough, the hard reality is you probably want to wait till 70 to maximize it out. If you have saved a bunch and you're planning on retiring early, okay, then maybe the conversation does start at taking it at 62, particularly if you are not going to be working. Remember, if you're under your full retirement age, there's a limitation as to how much money you can make and still collect Social Security. That's about $23,000, $24,000. Goes up a little bit every year, but it's not a big number in the grand scheme of things. So, and particularly why we would say if you're ready to retire, if you've got enough assets to retire, starting that Social Security, well, that means that you don't have to use as much of your assets or generate as much income from your assets, allowing them to grow and preserve their balance even more. And the reality is that the next generation, should you care about them or have one that you want to leave money to, the reality is that then that means that those assets, right? That's what folks are going to inherit. They're not going to inherit your Social Security. They're going to inherit your assets. So if you can reduce down the amount of income that you have to draw from those investments, that allows them to ultimately grow more, leaving more behind. So if you're somewhere in between, either you haven't saved enough and you got to wait till 70, or you've saved enough and you're going to start early, then that's where the analysis gets much more sophisticated. And certainly that's why we run those kinds of analysis in the office at Nelson Financial Planning. Speaking of that, this, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts out there on the World Wide Web. So make sure that you take the time to find us on your podcast platform of choice. Once there, make sure you subscribe, because then that way you'll get notified as to when new episodes are uploaded. Any trouble finding us, go to our website, Nelson Financial Planning, and you'll get immediately connected to our channel on the various platforms, including our YouTube channel as well. My name, of course, is Joel Garris, Certified Financial Planner, Certified Financial Fiduciary at Nelson Financial Planning. So another thing that can really kind of wreck, if you will, your quality of retirement is the notion of unnecessary debt. And this kind of goes hand in hand with what we were talking about last week in terms of kind of some of those purchases that you can make that ultimately have buyer's remorse that come with additional costs. Debt is not a good thing, and certainly when you have debt, then that means you have a monthly payment. So if you don't have the debt, then you don't have a monthly payment, which means in retirement, you can take that monthly payment and use it for something fun that you want to do rather than send it off to the bank. It certainly does impact your cash flow. Debt certainly impacts your cash flow. And one of the things that we always say before you can retire, certainly there should not be any credit card debt or anything along those lines. Next up on this list is not having sort of the right balance in your investment mix, right? This is probably important no matter how old you are, but particularly important as you approach retirement. The reality is that you should certainly have some portion that is on the conservative side, and that portion increases as you get closer to retirement. But here's the thing, and this is why we always want to kind of caveat this a little bit. I think in our view is that oftentimes people overdo this and put 40 or 50% of their portfolio into the more conservative bond or cash side of things. And certainly there's a lot of online articles and podcasts and whatnot that suggest that. But we don't agree with that. We think that is too much, because if you think of it this way, if you've got an investment portfolio and you're retiring, chances are you should be probably taking 4 or 5% off of that investment portfolio during the course of the year to generate a sustainable rate of income from your portfolio, right? Start doing more than that, 10, 12%, then you run the risk that your portfolio is going to run out of money before you run out of gas. And so what you want to do in that particular case is obviously stick with that withdrawal rate of 4 or 5%. Well, if you think of it this way, if the conservative part of a portfolio is to be there when the headlines, the markets, the economy aren't really all sunshine and roses, then if I'm supposed to take out 4 or 5% of the portfolio, well, how many years do I need on the conservative side to kind of get through those periods of time, right? So, if you've got 30% or 25%, that's like probably 6 or 7 years of potential income that you could get on the conservative side of your portfolio that would allow the equity side, the stock side of your portfolio to sort of recover. So if you think of it that way, I just don't know how you get to 40, 50, 60% on the cash and bond side for a retiree portfolio, because if it's 50%, I mean, how much money are you taking out every year? I mean, if you're taking out 4% and you've got 50% on the conservative side, that's, over 12 years of kind of covering that. The reality is that the market, while it certainly declines, it recovers as well, and usually that's within a 2 or 3 year period of time. So that's kind of the philosophy on kind of the mix, but you want to make sure that you're certainly adjusting it and have some portion that's on the more conservative side as you approach retirement. The next one, and this one, folks, keeps coming up on a regular basis, that is overspending on the kids, right? And whether that's, I'm going to provide Johnny a down payment, or I'm going to pay off Susie's student loans, or things like that. Folks, look, you got to come first in this analysis, and particularly if you're at or approaching retirement, start giving that money and using that money in large chunks right as you're approaching retirement or starting out retirement, then you really do run the risk of undermining the sustainability of your portfolio. And then next up on the Wall Street Journal's list of these kind of financial mistakes that are the most painful, particularly at or close to retirement, is underestimating how much your free time is going to cost you, right? Look, if you've got free time because you're not working anymore, the reality is that you're going to travel, or you're going to go spend time with grandkids, or whatever the case may be. All of that takes money. And so underestimating how much that free time expense is actually going to cost you is one big mistake. We're going to add in 2 more, which we think are equally important to the list that the Journal put together. Number 1, preparing for income taxes. Yes, you will have to pay income taxes in retirement. Yes, your Social Security is most likely going to be taxable as well. That comes as a big surprise to a lot of folks. Unfortunately, them's the rules. And so if you make above a certain level of income, which is not a very high level of income, then your Social Security is going to get included into your taxes. And then lastly, underestimating healthcare costs, right? I mean, that's a biggie. You've got to have an understanding of where those are, particularly if you're not quite yet Medicare age eligible, then that is going to be a significant amount of money that comes out of your pocket to pay for that. So those are some of the mistakes that you want to make sure that you avoid before you get to retirement or as you're approaching retirement. Next up on the program, we're going to talk about some firsthand observations for an IRS audit. So make sure you stay with us through the break. This is Dollars and Cents with Joel Garris of Nelson Financial Planning. So we've got some firsthand observations about what it means to be in an IRS audit. Frankly, these are very personal observations because I just recently completed a personal tax return for 2 years, 2021, 2022, that were audited, selected to be audited by the IRS. And I thought it important to sort of share my observations and the things that I learned along the way that you probably need to know as well if you hope to avoid getting audited, or if you find yourself in an audit, to not have to ultimately write a big giant check. And so we thought that this conversation would be particularly useful as to how to help our clients and our radio listeners and our podcast listeners to make sure that if they're veering into troubled waters, or at least understanding what's necessary to substantiate a deduction. And as our regular listeners know, you know that at the office at Nelson Financial Planning, we actually do tax preparation work for our clients. And let's face it, nothing beats the accuracy of having investment advice while actually having a completed tax return at your disposal in order to make sure that your retirement is as tax efficient as possible. And certainly the practical real life experience of having gone through an IRS audit on a personal basis certainly has helped just this past tax season in the advice that we're giving to clients in terms of how to approach things. And I guess that's the reality of experience, right? Let's face it, 25 years ago when I started in this business, my advice was probably not as good or as the advice that I give today, because the advice that I give today is based on observing, experiencing, seeing, and working with hundreds and hundreds of people over the course of the past 25 years. So these I guess events or experiences certainly do help to give some direction on what you need to do in terms of your tax return. So welcome on into the program. This course is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of the longest running radio programs here in Central Florida, also a top 25 financial planning podcast. Go ahead and find us on whatever your favorite platform is simply by going to our website, Nelson Financial Planning, where you'll get immediately connected over to our channels. While you're there, if you're interested in taking us up on our free offer of a current portfolio analysis that looks at where your hidden risks might be along with your costs, make sure you hit the contact us box and send us your name and phone number, and then we'd be more than happy to schedule an absolutely free conversation with you to do that in-depth analysis on where you are at today. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So I begin this conversation about sort of the firsthand personal observations of an IRS audit with the experience of just having gone through that over the course of the past 3.5 months. It has now settled out. Started out, got the letter in mid-December, and so mid-April it was finalized. We had done kind of all of the exchange, if you will, and so about a 4-month process. And I think the first question anybody asks is, oh well, why would somebody be selected? And I think in my particular case, my personal tax return, there's a variety of things on it. I mean, there's if I think at the main schedules, I've got a Schedule A because I itemize my deductions still because of charitable giving. B, interest and dividends. C, self-employment. We've got some of that. And then Schedule D, dividends, capital gains. E is investment property, rental property, ownership in businesses. I think the only one I don't have is F, which because I don't have a farm. But obviously mine is a more complicated return. Both my wife and I, of course, run our respective organizations, so our income is decent as well, and a number of deductions involving business, charity, investment-related things like that. Yes, when I'm not doing the radio show, I do in fact run a business. So normal that I would have gotten selected, I guess, because they really do look at returns that are more complicated, because that's where you might find more things that might be awry on them. In terms of the agency itself, the Internal Revenue Service in the agency itself, I've got sort of three observations that sort of struck me as I was dealing with them. And the first one is that the increase in agents is that's real. That's not just a headline thing. That is real. And that became very clear to me when I went in for my initial interview. And so that's part of the process. You go in for an initial interview, and then you document exchange, and then you go in for a final sort of interview. So when I went in for my initial interview, I was greeted by one individual coming off the elevator, and then I walked into a room, and there were three people there, which is kind of intimidating because it was just me. But two of the three, it was pointed out, were new hires, were trainees, is how they were specifically described. And so think about that potential ratio. So in that room, in that conversation, there was one person that had a tremendous amount of experience with the IRS, been there for a number of years, and then two new trainees. So do the math. Let's be clear, the IRS clearly staffing up. So that was kind of the first observation of the agency itself. The second, and I think this is kind of gets not accurately observed in the media. Look, these are people. I mean, at the end of the day, these are reasonable people that are running a much tighter ship, is how I would basically, kind of describe it. The IRS agents, unlike, the police that pulls you over for, a speeding ticket, or a sheriff's deputy who stops you for, having a blinker out or something like that. I mean, they are human beings too, after all. So I guess I would say let's not overreact to who they are, right? I mean, yes, some can carry guns. I don't believe anybody had a gun in the course of my interview. But the reality is that if you're lying on your tax return, you go to jail. You can ask Wesley Snipes about that. He spent 3 years in prison as a result of his escapades on his tax return. So the third observation that I would make in general on the agency itself would be, and it kind of goes to that theme of just kind of running a much tighter ship. That I think became readily apparent, certainly in some conversations we had with a number of professionals during the period of time we were in the audit. Positioning, I guess, not as accommodating as in the past, right? So you could describe it as a bit of a sort of an all or nothing kind of approach. Like if you didn't really have very good records in this category of expense, then yeah, we're going to disallow the entire category of expense. And that's kind of a little different, where you might have gotten partial credit, if you will, on things in the past. They ain't giving out partial credit. And I guess that is representative of sort of the increase in enforcement. And I mean, obviously the need from for that from a fundraising perspective is clear. I don't like the suggestion of, Americans are a bunch of tax cheats and liars and all of this, but the problem is that no political party wants to be accused of raising taxes. So how do you raise revenue without raising taxes? Well, the reality is that the tax code's pretty thick. And there's a lot of ways in which you can bring enforcement in different ways where you're increasing the amount of tax revenue, but you're not having to necessarily raise taxes. So just some kind of observations about the process and the agency itself. We're going to take a break. When we come back, we're going to kind of touch upon probably the most important part of this conversation, which is, what are they looking for? Like, what was the stuff that I had to provide? What are they looking for in terms of substantiating the deductions that you take on your tax return? So we're going to have that when we return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Yes, we continue this week's episode of Dollars and Cents, sharing some firsthand observations about what it is like to be in an audit of your personal tax return by the IRS, an experience that I just completed here over the course of the past 4 months. Not one that I plan to repeat, that is for sure. But on the program, we thought it would be good to kind of share with you some observations about the agency itself, which we did in the last segment. And then in this segment, we're going to share a little bit about exactly what they're looking for. And I think this part is probably the most important piece of the equation, because you have to have that understanding of what you're going to have to prove should you get into that situation. So the point of this is that if you're taking a deduction on your tax return, you better be able to kind of satisfy some of these elements that we're going to talk about in this segment of the program. Otherwise, it's going to get disallowed and you're going to have to write them a check. So what are they looking for? I think that's where we kind of start this conversation. And what do you need to demonstrate? And candidly, it was kind of a lot more than I thought they would, to be honest. The tax code and related interpretations is about 75,000 pages. So there's a lot of ways that things can get enforced that maybe simply haven't been. And so the first comment that I would make is that the agency seems to be really focused first on income, and specifically sort of proving that the money you get is capable of being traced back to your return. So one of the very first things that I got in the form of a document request was all my personal bank statements, all of my personal savings account statements, all of my business checking statements. And that's a lot of information, right? I mean, you're literally sending off all pages of those statements for, in my case, because it wound up spanning 2 years, a 24-month period of time. And yes, they're the IRS and they can request that, and you have to give it to them. That's the way it works. So, then it's the exercise of sort of tracking through all of the deposits and all of the transfers that were happening in those various accounts to see how they tie into the reported income on your return. So, I have an investment property, so there was some rent, and so it was okay. Well, we'll tie in that to the deposits that we see on these bank statements. I get a W-2 and I get a 1099, things like that. I had to kind of all balance those off of, what my tax document showed. I'd taken some money out of the kids' college savings accounts and then deposited that into the accounts in order to then pay for college. So they wanted to kind of see where that money was coming from. And so that's the exercise where you've got to be able to sort of track and show all of that, because I think it starts with that income, because that's really where you can get in the biggest amount of trouble, right? Underreporting income on your tax return, or not getting income that you're not putting on your tax return, because that really is going to create some major problems. And that's sort of where the audit exercise sort of starts, is auditing income relative to deposits. And for us, which is why I chose to kind of go through this process by myself, didn't hire outside counsel on it, we go through this all the time in our business, because we are a member, an SEC member, Securities and Exchange Commission member. We're a member of FINRA. We're a brokerage firm. So what we have to do is every year we have to do audited financial reports. And so when you're doing audited financial reports, you're literally like tracking that money, that check, every step of when it comes in the door, when it gets deposited, when it gets paid out. All of those steps are tracked. So, in the IRS audit, particularly on the income side, it isn't really a whole lot different than that. But for us, it's something that we're familiar with because you have to do it every year with our businesses. But if you're an individual and you've never gone through that, you might be a little surprised about that type of process and find that somewhat nerve-wracking. And the reality is, I couldn't quite remember every single deposit. Vast majority, sure. So there weren't really any issues. But here's the crazy part that I learned. This is a total aside on all of this. These mobile banking apps, right, that we use for digital banking, like I didn't want to do that. But then with COVID and all the banks getting shut down, and nobody able to come into a branch, I kind of got forced into doing that. And now, well, that's pretty much all that I do. I don't bother to go into the, into the banking center or whatever they call themselves now. But here's the crazy thing is that when you're literally taking pictures of these checks to like do mobile deposits, right? They only maintain copies of that stuff back for 18 months. I'm like, these are digital pictures that I'm uploading through your app, through your website. And by the way, this is a major financial institution. It wasn't a small financial institution where my personal bank accounts are. And it just struck me as unbelievable, right? What do you mean you can't provide a copy of this? So that was a little bit of a surprise and a little bit of an initial struggle in terms of getting some of this information, because I just assume, take these pictures and, upload them, and yeah, they're pictures and there's going to be a document. There ain't a document. And so when I talked to my bank about it, I'm like, hey, how can this not be available? Like, what are you talking about? And they're like, oh, well, it's a storage issue. We can't store all that. And I'm like, I thought the cloud was infinite. But anyway, so just an important point there is the importance of just holding on to stuff. And you would think in the digital age, I don't really need to hold on to it. But these banking apps only go back 18 months. So if you're trying to demonstrate a deposit or what a deposit was to the IRS from 2021, you ain't going to get it if you did it as a mobile bank deposit. So I guess the importance is to hold on to that stuff. So despite living in a digital world, you might not be as digital as you think. So that was probably one of the biggest surprises. So that's kind of the income side. After income, obviously, the conversation then moves to expenses, deductions. The reality is, and I learned this the hard way, is that if you're solely relying on credit card statements as your sort of proof of expense, as certainly I was, that's not going to be sufficient. What you need is so much more. I'll give you an example of kind of a meal. So let's say I went out with a client to a lunch, and not only do you need the Visa statement that obviously shows that it was put on the Visa and subsequently paid, but you need not just the credit card receipt, which I certainly would have grabbed that. But the thing that I never really grabbed, because it's just more paper, right? I'm trying to reduce paper, but the answer is keep the paper, is the itemization. You get the credit card, when the server gives you a little folio, and in there is the thing you sign, and there's a second copy, but there's a third thing in there, and that describes how many people were at the lunch, that describes what you ate, that describes everything. And that's the piece of paper that you need to make sure that you have in your records. That additional detail, that additional paper is crucial and is required. So I was a little surprised about that. That's just something that I'd never really kind of held on to. And then on the charitable gifting side, you really need to make sure that you have not just the letter acknowledging the gift, but also a copy of the canceled check. So they want to see both of those. And then the ability to demonstrate the details behind those kinds of expenses. So bottom line, what kind of struck me is that even though we're in a digital world, you probably just need to hold on to everything in paper form, because that certainly makes life a little bit easier in terms of proving and demonstrating. So that's the kind of the new normal. Expect more enforcement, if you will, all within the purview of the existing tax code, right? Because that's what the tax code's all about. But clearly, an IRS that is looking to hold people probably more accountable than what we've seen in the past. So hopefully you found some of that interesting. Maybe that will help you change your behavior to get you on better footing should that happen to you. Well, with that, we'll wrap it all up and get on out of here. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.